Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
All right, let's just jump right into it. We're talking about the high-stakes situation with Coupang, ticker CPNG. The stock has just been completely whipsawed by this confluence of a regulatory crisis and some serious governance issues after that December data breach. I mean, the stakes for this business, and really for anyone holding the stock, they couldn't be higher right now. We saw just extreme volatility last week, specifically that massive volume spike, and then the surge on December 26th. The stock just rocketed, I think it was about 9%, hit an intraday price of roughly $24.84. And that whole move, all of it, was driven by the company's quick assertion that, despite 33 million accounts being accessed, only a tiny fraction, just 3,000, actually had data retained.
A key distinction.
A very key distinction. And all this volatility, it gives us a really crystal clear central question. Does this recent price dislocation represent a strategic entry point, supported by the company's operational moat? Or is this acute multi-pronged regulatory crisis a structural impairment that just fundamentally undermines its long-term value? I'm going to argue that this volatility and that tactical reversal, well, it signals a classic dislocation event that should be aggressively bought.
And I'm going to present the counter-argument. Look, while the operational numbers are undeniably strong, I believe the regulatory and governance risk introduces a serious, unquantifiable tail risk. This isn't just a temporary headache. I think it fundamentally alters the investment profile, regardless of their current cash flow. The challenges coming out of Seoul are systemic, and the market reaction, even that relief rally you mentioned, it's been built on a foundation of completely unverified information.
Well, let's start with the math then, because I believe the initial sell-off was a textbook overreaction. It was just driven by sensationalist headlines. The evidence, which the company confirmed, shows the actual data liability affected a mere 3,000 accounts, not that 33 million headline number that sparked the panic. That nuance was priced in very quickly. But the core bullish thesis for me, it rests on execution. Coupang's fundamentals are just robust. They reported $9.3 billion in Q3 2025 revenue. That's up 18% year over year. And crucially, they're generating $1.3 billion in trailing 12-month free cash flow. So when we talk about fines, that FFC is a massive buffer. Any plausible penalty from this, even a stiff one, is highly unlikely to break the bank. Technically, the market has absorbed the selling pressure beautifully. The price action formed a textbook double bottom reversal pattern right around that critical $22 support zone.
Now, for those who don't know, a double bottom signifies seller exhaustion. The market tries to break lower twice, it fails, and that tells you demand has taken over. The December 26th rally then successfully reset the 14-day RSI from, deeply oversold territory, which means there's now room for more upside. We even saw retail sentiment on places like Reddit shift from panic to opportunistic buying, which helped create a floor.
I just come at it from a fundamentally different perspective. I think focusing only on that technical bottom ignores the profound change in the company's risk matrix. Yes, a $1.3 billion FCF is powerful, but that kind of liquidity, it can't easily absorb multi-year systemic tax assessments, which is exactly the risk we're facing now. The crisis goes so far beyond a simple data fine. The real risk is driven by the acute regulatory environment in Seoul, specifically the National Tax Service, the NTS. The NTS deployed agents from Bureau 4. You might hear this group called, colloquially, the Grim Reaper. And it is absolutely critical for investors to understand what that means. Bureau 4 specializes in high-level tax evasion and systemic corporate malfeasance. They do not mobilize for routine audits. Their presence signals a target on the company's entire financial structure. They are explicitly looking at cross-border profit shifting between the Korean entity and the U.S. parent company. This introduces a financial risk that is orders of magnitude greater than a data fine. We could be talking about massive back tax assessments that strain the balance sheet for years to come. And on top of that, there's this dangerous and immediate verification gap. The government's joint investigation team, which includes regulators like the MSIT, they've publicly stated they have not verified Coupang's claim of only 3,000 retained accounts. So the entire premise of the December 26 rally, the one you're highlighting, is priced on unverified corporate information. If the official report contradicts this, the downside is just massive. And finally, you can't ignore governance. The dual-class share structure where the founder has 29 votes per share, it concentrates power. That means regulatory enforcement becomes the only costly mechanism for accountability, which embeds a very high political risk premium right into the stock.
Right, which raises the fundamental question, can we even trust that relief rally?
Exactly. How can an investor rely on the stability at the $22 bottom and that surge to $24.84 when the entire foundation for it, that 3,000 retained number, is still pending verification from the government? If their report comes out and contradicts coupon statements, that rally faces a very high probability of a full retracement. All those gains just wiped out.
But the market price is forward risk, and while the government hasn't officially verified it, sophisticated investors aren't sitting around waiting for a press release. The stabilization we saw in the $22 range suggests the strong hands, they believe the downside risk is contained. Let's look at the volume profile on December 23rd, the day of maximum fear. We saw an astonishing 115.8 million in notional volume trade hands. That is characteristic of what we call a capitulation transfer.
Okay, so what does that actually mean for our listeners?
A capitulation transfer is that moment when panic selling just completely exhausts itself. The weak holders, people selling on fear, on margin calls, they liquidate at any price they can get. And then opportunistic capital, the so-called strong hands, they come in and absorb that massive volume. The crucial takeaway is this. The fact that the stock did not break new lows during that turnover suggests the market had already factored in the worst-case scenario. It decided that $22 is the floor. In other words, the risk premium based on maximum fear has been priced out. That handoff suggests the downside is contained no matter what the government finds, because the real sellers have already left the building.
That is a powerful argument about the clearing volume, but it leads me right into my concern about institutional behavior. You mentioned strong hands buying, but let's look at who was facilitating those trades. The market microstructure data, it reveals profound caution among the big players. We saw the off-exchange short volume ratio hit, 45.89% during the height of the crisis?
I appreciate the precision, but that ratio needs proper interpretation. I would argue that high off-exchange short volume is pretty typical market maker facilitation. They're responding to strong, concentrated buying demand, which you see in large block trades and dark pools, and it's so important to clarify, short volume is not the same thing as short interest. Total short interest is still negligible, only 1.65% of the float. This just confirms the pressure was from long liquidation, weak holder selling, not speculative shorting. The market makers simply sold short to fill institutional buy orders and then covered quickly. That explains why the stock stabilized so fast.
I'm sorry, I just don't buy that interpretation in this specific context. Let me tell you why. While high short volume can, yes, in a rising market signal facilitation, in the context of a steep 19% price decline and an active NTS rate, the whole calculus changes. That high ratio signals a highly defensive institutional posture. When liquidity providers are unwilling to hold unhedged inventory overnight because of this severe regulatory uncertainty, they actively hedge by selling short in unlit venues. That 45.89% ratio, to me, confirms institutional skepticism. It suggests the major players were actively selling the news, managing their risk, not taking on unhedged long positions with any kind of confidence. It's a signal of caution, not bullish conviction.
Okay, well, let's shift the focus back to the technical structure, because regardless of who was trading in the dark pools, the chart offers a very clear tactical path forward. We established that the double bottom is confirmed, not just by price stability at $22, but by bullish indicators, like the MACD divergence and the RSI reset we talked about. This structure implies a minimum reversal target.
And what does that tactical target look like?
A successful breakout above the neckline resistance, which is sitting around $26.50, it projects a measured move target of $30. This is a clear, structure-driven setup for an aggressive tactical buy trade. The chart suggests the short-term recovery has enough momentum to carry it back toward that previous high water mark.
That's an interesting point, though I would frame it differently. While a tactical trade back to the neckline might exist, the stock faces tremendous overhead supply. We have to remember the IPO legacy. Coupang priced its IPO at $35 back in 2021, so there is a massive cohort of legacy investors, what the market calls backholders, who are significantly underwater. This inventory creates a predictable and heavy supply of sell orders that will likely pop up around that psychological $25 to $30 mark as people try to break even. This institutional memory of the IPO price, it just dampens the velocity of any recovery. Moreover, structurally, the stock is still below its 200-day moving average and it's facing strong resistance at $27.12. The long-term trend is still firmly bearish until those levels are cleared. The path to $30 is littered with obstacles, not just catalysts.
Those obstacles are real, and that overhead supply is a valid friction point, but they are surmountable if the company just keeps executing. Which brings us to the most concerning element, the severity of that NTS Bureau 4 probe.
Yes, and this cannot be overstated. The presence of NTS Bureau 4 elevates the risk beyond typical fines. We established they're called the Grim Reaper because their mandate is systemic financial malfeasance. Their investigations historically result in devastating financial penalties. And the investigation is explicitly targeting transfer pricing mechanisms. Let's just clarify what that means. Transfer pricing is how a multinational sets prices for internal transactions, like fees the U.S. parent charges the Korean entity. If the NTS finds Coupang systematically use these to shift profits away from high-tax Korea to the lower-tax U.S., well, that opens the door to massive, multi-year back tax assessments. This is a stress test of the company's entire cross-border financial governance. How can you dismiss this highly specialized, high-stakes investigation as just a geographic risk?
I see why you think that. And look, I fully concede that the NTS investigation introduces significant, unquantifiable political and tax risk. I do. However, we have to place this specific geographic risk against the backdrop of the entire business. This risk is tied almost exclusively to the South Korean entity. We have to anchor our thesis in the fundamental execution that is happening outside of South Korea. The Taiwan expansion is providing crucial diversification and growth. It's hedging the company against exactly this sort of localized political risk. We saw the developing offerings revenue, which includes Taiwan, surge 32%. That rapid growth mitigates the existential reliance on the South Korean market. Management is actively executing a strategy that provides a financial safety valve against this kind of regulatory action. While the probe is underway, the business keeps growing rapidly in new territories, which absorbs risk and provides diversification that most localized e-commerce giants just lack.
But while diversification is a strategic benefit, we're talking about existential threats to the primary operation, not minor headwinds. The Korean market still represents the overwhelming majority of Coupang's revenue. A multi-billion-dollar NTS tax assessment could immediately force the company to drastically slow that international expansion. The growth in Taiwan is a hedge, maybe, but it is currently dwarfed by the potential liability looming over Korea. We cannot simply dismiss the Grim Reaper.
We are talking about severe regulatory duress applied to a fundamentally sound enterprise with a deep operational moat and over $1 billion in cash flow, and the market, through that capitulation transfer, has already priced in extreme duress.
And I believe the verification gap regarding those 3,000 accounts ensures that the true regulatory risk remains unquantifiable at this critical moment. Until the government speaks, the risk is skewed heavily to the downside.
So, to summarize my position, the current price levels, particularly around the $22 to $24 range, they offer an asymmetric opportunity. And it's an opportunity anchored by indisputably strong operational cash flow, that $1.3 billion in FCF, and a favorable technical structure defined by that double bottom. The market is pricing temporary duress, not structural failure. The risk-reward ratio, to me, it favors the long-term buyer here.
And I'll reiterate that the core uncertainty and risk lie in that governmental verification gap and the acute, potentially massive financial risk posed by the NTS Bureau 4's probe. Institutional players, as we saw in the dark pools, they remain skeptical. Until that regulatory overhang clears, which may take well into Q1 2026, the stock remains exposed to unquantifiable tail risk that just fundamentally compromises the investment thesis. Patience and active monitoring are paramount.
What this whole discussion really illuminates is the highly nuanced picture of CPNG right now. We have this confluence of indisputably strong operational metrics, the moat and math thesis, juxtaposed with severe, temporary, yet potentially devastating regulatory duress.
Exactly. And the final determination for any investor rests entirely on whether they choose to prioritize that operational strength against the volatility and uncertainty of the regulatory overhang. The material really requires assessing both macro risk governance and that forensic market data to form a robust conclusion.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.